Now that we've talked about how do we account for the cost of the asset, next we need to account for the use of the asset. Now remember, because this asset is going to last longer than a year, we need to spread the cost of the use of the asset over the life of the asset. We call that spreading of the cost depreciation. So, by definition, depreciation is the process of allocating to expense the cost of a plant asset over its useful life in a systematic manner. The process of cost allocation is not an asset valuation. You may have heard of the term depreciation outside of this accounting class in the context of valuation. I've heard in many situations where you buy a new car and you drive it off the lot and people tell you that the car has depreciated. Well, when they're talking there, they're talking about depreciation of value. Now, depreciation of value is an estimate, and therefore we cannot rely on depreciation of value when we look at an asset. As we said before, using the cost principle, we need to recognize our assets at what we paid for. So when we talk about depreciation of an asset from an accounting perspective, we are talking that we're allocating the cost of the asset over the life of the asset. It applies to all items that are property, plant, and equipment except for land. Land does not depreciate because the belief is that land will always be there. We depreciate the asset when we get the benefit of the use of the asset, so therefore we're relying on the matching principle when we create the journal entry to recognize depreciation. So the factors that we are concerned about when we have an asset are in three phases. The cost of the asset we talked about previously in terms of what it cost us to get the asset into its intended use. As we use the asset, we determine depreciation and recognize depreciation expense against the cost of the asset. And remember in earlier discussions where we talked about accumulated depreciation. We apply the accumulated depreciation against the cost of the asset to get the book value of the asset. Now, once the asset has been fully used, we have what we call salvage value. The salvage value is what the asset is worth or what we could sell it for at the end of its useful life. Now, it's very important that we know what the salvage value is because it'll be part of the depreciation calculation. So in essence, we have three things that we need to know in order to compute depreciation. We need to know the cost, the useful life in terms of years or hours or whatever the method is to determine useful life, and the salvage value of the asset. Now we use in this class three different ways of computing depreciation. Normally, most companies will determine which is the best method to depreciate an asset, and they will consistently apply that method amongst their assets and calculate the adjusting journal entry at the end of every period to determine how much depreciation to take. These three methods, straight line, declining balance, and units of activity, are all used within various companies out in the real world. Straight line is probably the easiest and therefore used more often by most companies. However, declining balance is used by many companies who believe that the useful life of an asset is more valuable when an asset is new rather than when it's older. Also, if they are trying to accelerate the depreciation for tax purposes, they may use an accelerated depreciation method such as the declining balance method to calculate depreciation so that they can take the depreciation expense earlier in the life of the asset, and therefore they will decrease net income so that they pay less tax. The last method is the units of activity method, which actually accounts for the usage of the asset. So these three methods you'll need to be able to calculate so that you'll be comfortable with how depreciation is calculated. So here's an example. Bill's Pizza buys a delivery truck on January 1st, 2012. Now remember, we can only depreciate an asset for the period of time that we own the asset. So therefore, if we purchase the asset on January 1st and the end of our year is December 31st and we own that asset for the entire year, we can take a full year's depreciation. If we only own the asset for a portion of the year, we can only take the depreciation for the period of time that we own the asset. So now let's take a look at this example. The cost of the asset was $13,000, the salvage value was $1,000, and the estimated useful life was 5 years or 100,000 miles. We need these four items if we're going to compute depreciation under these three methods: straight line, units of activity, or declining balance. Now the easiest method is called straight line. Now with straight line, we can come up with a formula to determine the depreciation expense that we are going to apply. As this slide shows, that the depreciation expense will be the same dollar amount every year. So we have to determine what the depreciable cost is, which is cost minus salvage value, and then divide the depreciable cost from its useful life. So if I was to determine a formula, I could say cost minus salvage value divided by useful life will give us my annual depreciation expense. So if I was to take a depreciation rate of 5 years, if I take the fraction 1 divided by 5, I will receive a rate of 20%. So I could use that depreciable cost of $12,000, which is the $13,000 minus the salvage value, and multiply times the 20% rate to get annual depreciation expense of $2,400 every year. Notice it's the same amount every year, and therefore the accumulated depreciation will increase by $2,400 each year to accumulate until the end of the life of the asset. Notice when we look at the book value is going down by the amount of depreciation we take every year. At the end of the 5th year, the book value is $1,000, which is our salvage value. So when you calculate depreciation and you create a table such as this, at the end of the useful life of the asset, the book value will equal the salvage value. If the book value equals the salvage value, you stop taking depreciation. If for some reason in your calculation the book value does not equal the salvage value and it's at the end of the useful life, you've made a mistake somewhere in your calculation. The journal entry, therefore, each year would be debit depreciation expense for $2,400, credit accumulated depreciation for $2,400. So now, as we said, we can only take depreciation for the part of the year we actually own the asset. So even though we're taking a 20% rate times the depreciable cost, if the asset was purchased on April 1st, we therefore have only owned the asset for 9 months, not 12. So when we figure out the $2,400 of annual depreciation expense, we can only take 9/12 of the depreciation, or $1,800. The remaining 3/12, or $600, would be depreciated at the end of its useful life in 2019. So the journal entry for 2014 would be debit depreciation expense for $1,800, credit accumulated depreciation for $1,800. We would take the $2,400 each year for the rest of the years until 2019. Another method is declining balance. Now, the declining balance is considered an accelerated method, as we mentioned before. What it does is it accelerates the amount of depreciation we take in the early years, normally with the rationale that the asset is more valuable in its early years than its later years. So what we have to do is we have to compute what the depreciable rate is, and we're going to increase that depreciation rate. So if we're using double declining balance, we would take the depreciation rate that we calculate and we multiply it times 2. So let's take a look here. Same situation as before, a $13,000 asset, and we take the declining balance rate, which was, remember, 1 divided by 5, 5 being the number of years in its useful life, which gives you 20%, times 2 because we're doing double declining balance. We would take the book value of the asset at the beginning of the year times the rate, 40%, to give us the annual depreciation expense. We would calculate the accumulated depreciation and the book value at the end of the year, and that ending book value will become the beginning book value in the next year. Then we apply the depreciation rate again for the next year to get the new annual depreciation and continue on until the end of its useful life. Notice in 2018, we could not take 1,685 times 40%, because if we did, the depreciation we would have calculated would have been too high and we would have made our book value less than $1,000. Remember, we said as soon as we have our book value equaling the salvage value, we stop taking depreciation. So therefore, in 2018, what we had to do is take depreciation expense only for the amount to get us to the book value. The next method is called units of activity, and a lot of times companies like the units of activity because what it does is it takes depreciation on the actual usage of the asset. So for instance, in a delivery truck, we might say that the delivery truck can be driven for 100,000 miles as its useful life. So once again, from a formula standpoint, the depreciable cost is the cost of the asset minus the salvage value, and then we have to figure out what the cost per unit based upon the units of activity. So we take the depreciable cost and divide it by the estimated units of activity, 100,000 miles, to get the depreciation per unit, or in this particular case, 12 cents per mile. So then, if the company has driven that truck in this first year 15,000 miles, we would apply the 15,000 miles times the 12 cents to get annual depreciation of $1,800. So what happens here is that we need to know how much we've used this asset. So if we've been driving the truck for 15,000 miles, we would take 15,000 times 12 cents. And we would take the depreciation. We would do the next in the next year if it was 30,000 times 12 cents or 20,000 times 12 cents. But ultimately, we stop taking depreciation when the book value equals the salvage value. So here's a comparison of the different depreciation methods. In this top box on your right hand side, it shows that for the 5 years, straight line gives us the same depreciation every year, same dollar amount. Using the declining balance method, you can see where in the early years, declining balance takes more depreciation, but as the years get later, the depreciation amount is less because there's less to depreciate. and then the unit of activities bases its depreciation on the actual usage. But in any case of these three methods, they always come up with the same amount of depreciation at the end of its useful life. So you can see where the declining balance will start high and end up low, the straight line will stay the same, and the units of activity will go up and down depending upon usage. Now, for depreciation and income taxes, the IRS does not require a taxpayer to use the same depreciation method for tax purposes as they use for financial statements. So therefore, on your financial statements, you can use straight line or declining balance or units of activity. For tax purposes, the IRS requires us to use a system called the Modified Accelerated Cost Recovery System. In essence, MACRS is a modification of declining balance. However, because it's not a consistent application of any particular method in terms of how we get to the percentages that we use for depreciation, we cannot use MACRS for generally accepted accounting principles and the creation of financial statements. When we disclose depreciation in our footnotes, we have to tell the reader of our financial statements exactly the rules and our assumptions in the calculation of depreciation. We have to tell the reader the method, the useful life. If there's significant salvage value, we have to tell the readers everything. That's just appropriate disclosure. Now, what happens about depreciation if you change your mind or you change your estimate? One of the nice things about depreciation is that everyone understands that depreciation methods are an estimate of how to allocate depreciation. The only number in cost, salvage value, and useful life that is for sure is the cost. Useful life and salvage values are estimates by management as to how long that asset will last, as well as what's the asset worth at the end of its life. So you could actually change your mind as to what the useful life or salvage value is. So if you do not go back and recalculate your depreciation. Instead, you take your book value at the time of the change and recalculate your depreciation based upon your new assumptions, taking into account what you've already done. This is not considered a mistake or error because all it is a change in estimate. So let's look at this example. Arcadia High School purchases equipment for $510,000, which has an estimated useful life of 10 years with a salvage value of $10,000 at the end of its life. Depreciation has been recorded for 7 years on a straight line basis. In 2014, otherwise year 8, it is determined that the total estimated life should be 15 years, not 10 years, and the salvage value should be $5,000, not $10,000 at the end of the time. So what's the journal entry to correct prior year's depreciation, and what's the new depreciation expense? As we mentioned before, the changing of the depreciation estimate, the useful life, or the salvage value does not require you to go back to correct the prior year's depreciation. So therefore, you don't need to calculate an adjusting journal entry. But you do need to calculate how much the new depreciation will be in year 8. So what we have to do is we have to determine how much is the book value at the time of the change. So what we first have to do is we take the equipment cost minus the $10,000, since that $510,000 was the cost and will not change. The salvage value at the time of acquisition was $10,000, so the depreciable base was 500,000 and we had an original useful life of 10 years. So, our annual depreciation rate based upon our original assumptions was $50,000. We take the $50,000 times the number of years that we use the $50,000 rate times 7 to get accumulated depreciation of $350,000. So if we take the original cost of $510,000, subtract out the accumulated depreciation of $350,000, we get a book value of $160,000 at the end of the 7th year. In the 8th year, we change the estimates of salvage value and useful life. Now remember, we've already used it for 7 years, so what we cannot go back and recreate 7 years. We want to look forward. So what we have is 8 more years of its useful life. And the salvage value has been decreased to $5,000. So we take the book value, subtract out the new salvage value to get our new depreciable base, divide it by our remaining useful life to receive an annual depreciation rate of $19,375 each year until the end of its useful life. So the journal entry would stay the same: debit depreciation expense, credit accumulated depreciation, but the new annual depreciation has been adjusted to the levels based upon the new salvage value and the new useful life. Now the next question that comes up is, what about the cost to keep that asset running, or the additional costs that we put into that asset? We have either ordinary repairs or additions and improvements. Ordinary repairs are considered revenue expenditures, and we would then expense them as they're incurred. Additions and improvements are considered capital expenditures, and we increase the cost of the asset at the time of the improvement, and then we have to recalculate the depreciation. So think of it this way: a revenue expenditure is one of those items that we are going to incur on a normal ordinary use. A capital expenditure is an expenditure to improve the asset or improve its operations or extend its useful life. Here's an example. Assume that we have a car that we just love. We go and we do the maintenance on this car, the oil changes, the tune-ups, new tires, new brakes, because without those expenditures that we pay for those repairs, the car wouldn't be operational. Those are considered ordinary repairs, and we would expense those ordinary repairs on our income statement in the period we incur those costs. Now, for instance, we now take our car and it's run its course, and now the car needs a new engine. We pay for this new engine, and now we can drive this car for another 100,000 miles or another 5 years. Because the expenditure increased the useful life and extended its operations, we consider that a capital expenditure, and we take that expenditure and we place it on the balance sheet, and then we depreciate that expenditure over the life of the asset. Here's an example. Assume that we have a car that we've been using for some time. Over time, we've incurred expenditures for the oil changes, the new brakes, the tires that are the normal upkeep of the asset. Those expenditures are considered revenue expenditures and ordinary repairs. Therefore, we would want to expense those expenditures on the income statement in the period they are incurred. Now, if we take that vehicle and now we have to put a new engine into that vehicle. By putting a new engine in that vehicle, we can drive that vehicle for another 100,000 miles. By doing that expenditure, we've extended the useful life and we've probably increased the value of that asset at the time. So we need to take that expenditure and increase it to the book value to determine a new book value and then recompute the calculation for depreciation. Another issue that comes up with plant assets is what happens when a plant asset decreases in fair value. In the event that it is permanently decreased, we need to make an adjusting journal entry to reduce the fair value of the asset down to what it is in the real world. So, we need to make an adjusting journal entry to reduce the cost to fair value and recognize that it has been impaired. One of the things that we have to determine through the life of the asset is what do we do at the end of the asset's useful life. In some cases, we will sell the asset. Other times, we'll retire the asset, or the other is to exchange the asset. In all cases, the common part that we have to do for all three methods of disposal is to get the old asset off the books and the accumulated depreciation related to that asset off the books. So let's talk about how we sell an asset. If we sell an asset, we will receive cash or some other compensation for the asset. So we need to recognize the receipt of the compensation. We have to take the old asset off the books. We have to take the accumulated depreciation off the books. And the difference of the book value from the sales price will either be a gain or a loss on the disposal. So here's an example. On July 1st, 2014, Wright Company sells office furniture for $16,000. The office furniture originally had a cost of $60,000 and had accumulated depreciation of $41,000. The depreciation for the 6 months in 2014 is $8,000. So what's the journal entry first to record the depreciation expense for 2014? Remember, we sold the asset on July 1st. So one of the first things on the disposal is to get the book value current. So we have to recognize the depreciation expense for the first 6 months. So we need to do the journal entry, debit depreciation expense, credit accumulated depreciation for the first 6 months of depreciation of $8,000. Now we have a new book value of $11,000. We received the $11,000 by taking the cost of the asset minus the updated accumulated depreciation. We sold the asset for $16,000, so what we did is receive $16,000 in cash, and the difference between the sales price and the book value is a $5,000 gain. So the journal entry would be debit the cash received of $16,000, debit the accumulated depreciation of $49,000. And how did we get that number? Because remember, the normal balance of an asset for accumulated depreciation is a credit. So to get a credit balance off the books, we have to do a debit entry. Then we need to take the equipment off the books that has a normal balance of a debit, so we have to do a credit entry, and then we recognize the difference as the gain on the disposal of the plant asset. So now let's change the scenario here that instead we sell the asset for $9,000. If we have a book value of $11,000 and we sell it for $9,000, we now have taken a loss of $2,000. So we still receive $9,000 in cash, so we do a debit journal entry. We still have to take the accumulated depreciation off the books and the equipment off the books. But now we need to do a debit for the loss on the disposal of the asset, the $2,000. Now, what happens if we don't sell it? We just junk it or we give it away. In that case, we really haven't sold the asset and we receive no cash compensation for the removal of the asset. So therefore, we still have a book value, but we haven't sold it. So what we still have to do is take the equipment off the books, the accumulated depreciation off the books, and if there's any book value remaining, that becomes a loss. So here's an illustration. Assume that Hobart Enterprises retires its computer printers, which have a cost of $32,000, and its depreciation accumulated is $32,000. We would take it off the books by debiting the accumulated depreciation for $32,000 and crediting printing equipment for $32,000. The equipment was fully depreciated, there was no salvage value, so therefore no loss. Now, when we look at assets, a lot of times management wants to look at the assets as a return on assets. In other words, if I'm going to invest in assets, I need to know what I'm making for that investment. So the return on assets formula is net income divided by average total assets. Now remember, whenever we use the term average, we're taking the beginning balance for the year plus the ending balance for the year and dividing it by 2. So therefore, net income of 86 divided by the beginning plus the ending divided by 2 gives us a return on assets for a company like JetBlue of 1.3%. Their return on assets in 2010 was 1.5%. In other words, their return was less in 2011. We look at Southwest, their competitor, at 1.1%, which basically tells us that they're doing better than Southwest Airlines. However, the industry average in 2011 was 4%. So therefore, JetBlue and Southwest are doing less well than in the industry. Now, why is return on investment important for most investors? Return on investment tells most investors how well they're investing their money. So whatever situation in terms of going out and buying investments, we always want to know what are we getting in return. Otherwise, why would we want to invest in the first place? Another ratio that we might want to look at is called the asset turnover ratio. Now remember, when we talked about turnover was the time that we have something till its replacement. So now we want to know is take the net sales divided by average total assets. Very similar to the other asset ratio, but this one, instead of net income, we're looking at net sales. Is how much are we selling for our assets. So once again, take the net sales divided by the beginning plus the ending assets divided by 2. We can see that the JetBlue is 0.66 times, whereas Southwest is 0.93 times and the industry is 0.8 times. The higher the number, the better the company's doing. So in this particular case, in the previous ratio, JetBlue was doing better than Southwest. In this situation of the asset turnover, Southwest is doing better. When you put these two ratios side by side, you get a picture of how the companies are doing in relationship to each other when it comes to how effective they are with their assets. And we've already talked about the profit margin ratio. So we can take the profit margin ratio to evaluate the return on assets ratio when we look at its competitors. So when we look at JetBlue and Southwest down in illustration 9.2, the profit margin ratio where JetBlue is doing better than Southwest, and then we look at the asset turnover ratio where Southwest is doing better than JetBlue. So when we look on return on assets as a whole, we can see that JetBlue is doing slightly better than Southwest Airlines. So you can kind of see where all these ratios need to be working together to give you a better picture of how a company is going.